Hello everyone, welcome to Dollars with Diz. In today's video, we're going to discuss what a mortgage is. All right, so if you actually Google what is a mortgage, you're going to get a lot of links that lead you to different definitions. There's a handful of them. So what I did is I took three that we're just going to chat through, and then, we're going to see how they're similar on the next slide, and then kind of come up with our own definition at the end of this. So I'm just going to read through these really quickly with you. So the first one, taken directly from the Oxford Dictionary, reads as this: a legal agreement by which a bank or other creditor lends money at interest in exchange for taking title of the debtor's property, with the condition that the conveyance of the title becomes void upon the payment of the debt. Probably my least favorite definition that I have on this slide. It's pretty complicated for something that we kind of want to make a little more easy to understand. So the next one, Investopedia, one of my favorite sites to go to when I'm looking up financial information, has a pretty good definition. Actually, not as good as the bottom one, but for Investopedia, basically it says, a mortgage is a loan used to purchase or maintain a home, plot of land, or other real estate. The borrower agrees to pay the lender over time, typically in a series of regular payments divided into principal and interest. The property then serves as collateral to secure the loan. So this definition is definitely getting a little more clear. Definitely has some more words that make a little more sense, but I actually think the last definition we have here is kind of the easiest one. Again, as you can see, one Google search of what a mortgage is can provide many different responses. So the last one here, coming directly from the Consumer Financial Protection Bureau, is a mortgage is an agreement between you and a lender that gives the lender the right to take your property if you don't repay the money you've borrowed plus interest. So that, I think, is the most straightforward internet definition. So on the next slide, we're just going to go over how these all kind of interconnect and how they are saying the same thing, but just sometimes using, a lot of different words to. So what I did here is I took those definitions and I've highlighted sections of them that relate to each other. So that way we can kind of see that they all are saying the same thing, just using different words and laying it out a different way. So first, what they're all saying is that there's an agreement between you and a bank, also called a lender or creditor. So you can see in the first one, a legal agreement. In the second one, it doesn't state a physical document, but it's saying that you as the borrower agrees to something. So there's an agreement in effect on that sense. And then of course, in the third one, it literally says another agreement. Okay, so for one, they're all saying that there's a agreement between you and the lender or some other party. The second part of these definitions says, the bank is going to give you money to buy the house, expecting that you will pay it back. If you don't, then they can come and take that house. So you can see in the top here, they're lending you money. And the second one, the mortgage is a loan. So you're receiving money from someone else that you have to pay back. And then the last one, it says, the money that you've borrowed plus interest. So again, you are receiving something from the bank and you're using that to purchase a house. Then it says in the same vein here, if you don't, they can take that house from you. So in the first one, it says, they're lending you the money. In exchange, they can take the title of the debtor's property. So it's saying here that if you don't pay back, then they can take title, which is just, saying who owns the property for that property. So if you don't pay them back, you will lose the property, and the creditor or bank will come and seize that. In the second definition, it says the property then serves as collateral. So collateral is just another way of saying, when you don't pay them back, they'll take it from you to make up the money that they're losing because you're not paying them back. So it's serving as collateral to secure that loan. And then the last one here, it says it gives the lender the right to take your property. So right up says, if you don't make these payments, then you will have your property taken from you by the lender who loaned you that money. And then the last thing, obviously number two, it says if you don't pay them back, they can take the house. So that means you're also agreeing to repay that loan over time. So in the first definition, this transfer of the title becomes void upon the payment of the debt. So up here, once you pay all that debt back, the ability for the bank to take that property goes away. So you're agreeing to pay it, and once you do, the house is yours and no one can take it from you. In the second one, it says, the borrower agrees to pay the lender over time. So again, you're agreeing to pay them over time. And then in the last one, it straight up just says, if you don't repay, so you're saying you're paying it, again, they can take that property. So you're agreeing to pay back. So altogether, the three main points of this definition are an agreement that says the bank's going to lend you money to buy a property that you are going to pay back. And if you don't, they're going to take that property back from you. So that's the main gist of this. Now we're just going to come up with our kind of own definition of what a mortgage is. We're going to use simple terms, again, highlighting those three key points we discussed in the previous slide. So our definition of a mortgage is a loan agreement between you and a bank where the bank provides the funds to help you purchase a home. In return, you agree to repay the loan over time. If you fail to make the required payments, the bank has the right to take ownership of the home. So again, number one, it is an agreement. Number two, if you fail to make payments, the bank has the right to take ownership of the home. And number three, you are agreeing to repay this loan. If you do not, again, the bank will come and take ownership of that property or home. All right, so I wanted to provide a quick flow chart of everything we kind of discussed. I haven't included any numbers yet, but I think this will just give you a kind of general sense of where we're at and how everything flows together. So here's you in the top right corner, and you're wanting to buy your dream home down here. The only problem is you don't have enough money to do so. So you're going to go over to the bank, and you guys are going to talk about it and agree to sign a mortgage. You're going to sign an agreement. So here's the mortgage, and they're going to send the money over to you to buy your home. Within that agreement, again, you're committing to making payments directly to them. So every month you're going to send money back to the bank to kind of reimburse them for the money that they gave you to purchase the house. Now, if at some point, for some reason, you can no longer make those payments, within this agreement, there's the right for the bank to take that property. So at some point, if you don't have enough money to pay the payments, the bank will come in and say, hey, this is happening. You signed this mortgage agreement. You agreed to these terms. Now I'm going to have to come. I'm sorry. I'm going to have to come and take this property because you can't make those payments. So it's going to come, and the bank would then become the owner of the property. Obviously, that's a worst case scenario. And the main part of this flow chart is the top, where you get the flow of money from them, you buy the house, and then over the life of the mortgage, you pay the bank back. That's it for this video. Thank you for watching Dollars with Diz. And of course, if you have any questions or feedback, please leave them below in the comments and we'll get back to you as soon as possible. All right, I'll talk to you next time.